What's your take on Amazon right here? A lot of people name Amazon as the real expensive one. Is that trading at about, what, 100 times cash flow or 90 times cash flow?
Yeah, Amazon is historically very expensive, and there are, I call it the tyranny of the anecdote. There are companies that trade at 80 or 100 times pre-tax earnings that are worthwhile. But if you go back in history and look back over 20, 30, 40, 50 years, the world's worst strategy is to buy companies that lose money or are trading at 100 times pre-tax cash flow. So you can pick out the few diamonds in the rough, and Amazon, my bet, would be one of those, and everyone knows that name. But it gets people speculating in other names that aren't quite as good a business and throwing caution to the wind there, and I think that's where you get hurt mostly. Amazon's run by a pretty special guy, and tough to bet against him. It's also tough to come up with a valuation. So, some businesses you put in the too hard pile. You're not exactly sure what kind of premium they're worth. It's not infinite. But Amazon is a unicorn that I don't want to speculate on.
Yeah, you know what? You make a lot of really important points, particularly on the leadership point. You've got to know and understand who's running the business, and really you trust things that way sometimes, more so than when you look at a valuation situation. Let me ask you about the bond market, Joel, and this worry over 3% on the 10-year. Is that justified? I don't predict interest rates, but what I will tell you is the way we look at it is bonds are competition for stocks, and until there will be corrections as the interest rates move up, but we assume when I gave you those valuations for the market before, we normalize our interest rates over time. So we're still well below normal. So there's room for the long-term bond rate to go up without being the thing that totally impacts stocks. But of course, over the long term, if they were to move up 2 points from here, obviously that will impact stocks. It'll be tougher for them to compete. People will be willing to pay a little less, and I think that's fair. But I don't know where they're going to go. Over time, we normalize, and if you want to assume that rates are below normal, which we do, I gave you valuations that take that into account. So we're in the 16th percentile towards expensive, which means expensive but still expecting positive returns. So no reason to run around screaming. Markets, it doesn't necessarily have to fall precipitously, even though we're expensive historically, and even if rates go up a little bit from here. Yeah, I mean, when you look at where we are, come on, you're coming off of rock bottom rates. No kidding, we're at 2.9% from zero and negative in some areas of the world. But 2.9% is still just 2.9%. In terms of, running around nervous, that's what's happening, though, right? You see these 1,000-point moves, 300-point moves up and down. It feels like volatility is back.
Yeah, but I think that's a good thing. When we had, over the last few years, that's the abnormal part. That's before this latest volatility. Stocks should be volatile. They have different fundamentals. When they all move in lockstep together up, and there's limited volatility, that's not actually normal. Stocks have individual outlooks. They should react individual, not as a group, to what's happening in the overall economy. And I think when you start seeing discernment and more volatility, that's good news for stock picker. That's good news for rationality. That almost keeps us out of trouble long term. Doesn't put us in trouble. If the market just slowly floats up and everything goes together, that's not normal or good. And so this volatility, I think, is very healthy.